Welcome to the Holistic Wealth and Health Podcast. Your co-hosts, Jason Smith and Bryan Bibbo, will inspire and teach you how to prosper in your mind, body, and spirit, not just your financial life. Joining forces with field experts, Jason and Bryan are here to help you focus on what matters most in your life, living well.
Hello, and welcome back to the J.L. Smith Holistic Wealth and Health Podcast. I'm your host, Bryan Bibbo. I'm excited to have this guest on here today, friend, colleague of mine, Dave Alison, CFP, EA, Bucket Plan Certified. He is a distinguished wealth manager and entrepreneur and is also the president of Prosperity Capital Advisors, a well-known thought leader in the industry and a specialist in serving high and ultra-high net worth clients. Dave has received numerous accolades and awards throughout his career. Thank you, Dave, for taking the time out of your busy schedule and the other appearances that you have going on to be here today.
Yeah, I'm happy to be here, Bryan. Thanks for having me and great to be back on the podcast.
Yeah. And what I want to really discuss today, the topic of something you formulated for all of our advisors out there where we can sit in front of clients and give state-of-the-art tax knowledge. It's called the tax management journey. It's a process. As I said, all the advisors go through here at C2P, PCA, and it's really where we can help the clients more, retain more of their money, and be strategic about lowering their lifetime tax bill, right? We always like to say the goal is to pay the least amount of taxes legally possible and really take advantage of the laws that are out there. And we know with the big, beautiful bill, a lot has changed in that landscape. But let's start. Dave, why do you think this is so valuable for the clients, and this framework you've put into place can kind of change lives, especially about the money they take home and future wealth?
Yeah, I think that it's so important because if you think about taxation, it's most of our largest expense throughout our entire lifetime. Like, we spend all these years hustling, working hard, trying to save money, trying to build financial stability. And throughout our entire accumulation phase, we have a partner in every paycheck, as you know, and that's Uncle Sam. Part of our money gets deducted to pay for income taxes. And so that's, a headway against us in terms of building our own financial stability. And the reality of it is those tax dollars, some people could argue they go to really good things. Other people can argue that they don't like the way the government spends their money. But the reality of it is we need money as a country to run some of the shared services that we all benefit from. And then at some point, you build up this financial nest egg, you become financially independent, and you go to retire. You start to live off of that hard-earned savings that you've accumulated. But the reality of it is tax doesn't go away. You're still taxed in retirement. And a lot of people have this misconception that when they go to retire, their tax liability is going to be lower. And for some people, that is the case, but it's certainly not the case for everyone. I've seen many families and clients that their taxes actually increase when they retire because they don't understand the mechanics of tax-efficient retirement income. They don't understand how deductions can get phased in and phased out. They don't understand the taxation of Social Security or Medicare. And so again, there's a lot of confusion and complexity around this topic. And typically what happens is without a good plan and good strategy, most people end up overpaying. And I know for the clients and the advisors that I've worked with, most of them don't mind paying taxes. They just don't want to unnecessarily overpay in taxes. And then the final part of this, unfortunately, is for some families, they're even taxed after they pass away. Because if you've accumulated assets in a certain way, and your intent is to leave those assets to your family, your children, your grandchildren, your beneficiaries could face a substantial tax on the transfer of your assets from you to them. And so taxes kind of haunt us when we're accumulating, when we're in retirement, and when we're in distribution, and then, from the grave upon our passing to our beneficiaries. And so I think it's just so important for clients to understand that, again, we all have a duty to pay taxes, but what I like to prevent is leakage, right? You've built this great net worth, this great financial asset for you to be able to live off of and for you to enjoy. And we just don't want to leak out any excess money to taxes that we unnecessarily have to.
Yeah. I mean, it's the old saying, right? It's the old adage, there's two things is guaranteed death and taxes. And now you just hit us with, hey, there's taxes after we die too on the transfer of our assets in a lot of cases, right?
Exactly. I mean, when you think about the evolution of savings in our country, many of maybe our senior generation clients, kind of the greatest generation as it's known, they didn't really have to accumulate a lot of retirement account balances on their own because when they retired, what did they have? Old school pensions. Well, that went away. And, companies didn't want that liability on their balance sheet because it became harder and harder to meet and exceed that liability. Well, then the introduction of 401ks came around, and the government needed to incentivize people to put money into these 401ks and retirement savings accounts. So they allowed a client to take a tax deferral to do so. And I say a tax deferral and not a tax deduction because many people believe it's a tax deduction. It is not. It's a tax deferral. You have to pay that tax at some point when you take the money out, whether it's you in retirement, whether it's your surviving spouse upon your passing when they inherit the retirement account, or whether it's your children or grandchildren upon your demise when we think about legacy planning. And so that's just one example of the reality of where we exist today, is that the majority of Americans who are seniors, boomers, different generations, Brian, our generation, we're building up these big piles of money in tax deferred accounts. And so the piper has got to be paid at some point. And on top of that, there's no certainty of what future taxes look like. I mean, they could be higher, they could be lower. We've got a huge amount of debt and deficit. We know we need to raise money to be able to pay and service that debt. So a lot of people think it could be higher. Maybe not, right? We don't have a crystal ball. Maybe they are lower. But the reality of it is most people have a large liability with the pre-tax retirement accounts they've accumulated. Then the government started to introduce the exact opposite, right? Roth accounts, ways that we could not take the deferral up front, but we could have tax deferral on our investments over time. And then when we take that money out, it's tax-free later on in life. And so now we kind of have a complex conundrum of like, do we defer now and be taxed later? Do we pay the tax now and take tax-free later? And there's not a one-size-fits-all solution. Like if you're having water cooler talk next to your friend at work and they're telling you what they are doing, that doesn't necessarily mean it's the right fit for you and your family because there's so many other circumstances. Maybe you'll have a large windfall. Maybe your spouse is a high income earner. Maybe you're, going to be getting an inheritance later on in life. Like there's just so many moving parts that create this complexity that like my goal was that we want to help our families protect what continues to take a lifetime to accumulate. And we do that through really good, sound financial planning. We do that through really good asset management, protection planning, legacy planning. But the big one is tax management, because that is, for most of us, the single largest expense that we're going to pay throughout our lifetimes.
Yeah. I mean, it's the thing, words matter, right? Just the mind shift from saying, I'm going to get a tax deduction, but it's not really, you're getting that deduction, quote unquote, today, but really it's that tax deferral. Eventually we owe Uncle Sam on that money we've deferred away in those 401ks. And why we go down the thought process of these words matter. There's a cornerstone phrase, Dave, of the tax management journey I've heard you consistently say, and it's stuck with me, and I want to share with the audience. And that phrase is, it's not what you make, it's what you keep, right? It's not what you make, it's what you keep. Why is that so powerful, and why do we got to make sure everyone understands that?
Well, I think for most of us, our mindset is focused on the wrong target, right? Like, I can't tell you how many times I meet with money managers or clients that, want to share with me what their performance on their statements from Fidelity or Vanguard or whatnot look like. And it'll show me like a gross return. I made 10%, I made 12%, I made 20%. But that's not what you get to keep. That's not your net return. That's your gross return, right? It's like me telling you how much my house is worth, but not disclosing to you how much of a mortgage I have on it, right? It's not the net equity, it's the gross. And so, for all of us, I think we can relate back to like maybe our first paycheck, right? We get our first paycheck, and is it the gross amount that we get deposited into our checking account or the net amount? And we all know we can't live on gross. We can only live on net. And so when we think about this as one of our many principles of our decision-making framework, we just really need to be able to understand the true cost and opportunities in the decisions that we make. Because every decision when it comes to our financial planning and well-being has a trade-off. I used the example earlier. Do we defer now and pay tax later? Or do we pay tax now and have it tax-free later? That's a trade-off. Do we invest in this stock or this bond? Do we invest in this mutual fund or this ETF, right? Like, all of these things have trade-offs. But at the end of the day, we have to have accurate measurement of how we determine success or outcome, right? To be able to help navigate what trade-off works best for you. And again, I always share it's not what you make, it's what you keep, because that's such a good decision. And I'll give you a story, Bryan. I had a client that came to me a couple months ago, and they were interviewing me and our firm at Prosperity, you and our other advisors, but they wanted to chat about the investment side of things. And they were a pretty high income earning client in California, actually. So they were in the top federal and state tax brackets, paying almost 50 cents on the dollar in any investment income and short-term capital gain, and then 37% on long-term capital gain or qualified dividend income. And that's because at the federal level on investment income, you're taxed at the highest marginal rate, or this client was, of 37%. Plus about 3.8% in net investment income, and then plus state of California, 13% taxes on any income. And then on capital gains and qualified dividends, you're more preferentially taxed at 20% federal instead of 37%, but then the rest of the 3.8% and the net investment income. And this is relevant for any state, right? Ohio or anywhere else, you have state income taxes and federal income taxes. But they were really, really proud about their portfolio of their other advisor. And, they were sharing in like a year, and I can't remember the exact numbers. I think it was last year, like the market did whatever it did, 17, 18% return, the United States market, and their portfolio did like 25% return. So they were talking about how the stock trading, the ETF trading that their advisor was doing was really good. It was generating a 25% return on the equity side. And then that advisor had them in some private credit alternative investments that were kicking off about a 10% yield. So think about that, 25%, 10%, really good returns. But I said, this is what you made, but not what you kept. So let's factor taxes. And on the stock trading, a lot of that was short-term capital gain taxed at ordinary income. So that immediately chopped their 25% gross return down to about 12.5% because 50% went out the door to income taxes. On the private credit fund, it went from about a 10% yield down to a net 5%. So now all of a sudden, instead of bragging about 25 and 10, we were really looking at more like 12.5 and 5. And what that strategy did is it made the government a lot of money, but it wasn't as much money as the client could have kept if they had a lot more of a tax-aware strategy. And I mean, Bryan, how many times do you see this every single day with people coming into your office?
It happens all the time. I mean, and that's the differentiating factor. You see a lot of just asset managers out there. And I always say the differentiating factor where JL Smith, Prosperity Capital Advisors, and the advisors that belong is that holistic wealth planning. And it's looking at the bigger picture of like, hey, tax management is such a crucial aspect to how much you get to keep. Yeah, to your point, 25% was a great return. But if you're going to pay 50% taxes because there's no tax strategy behind it, well, guess what? You really kept 12 and a half. It's the same thing when you have people come in and they have this bank interest and they're so proud of their CDs that were earning 4.5%, 5%, right? And then we go and you're at a 24% tax bracket federal. You owe the state another 4%. So let's do some math here. Yeah, you might have made 4, but at the end of the day, you made 3 or less because of the taxation of it. There's a smarter way of how to use our money out there, and we just need to be aware of it. And while we're on this train of thought, and we think about the tax management journey here, one of the biggest aha moments I had going through the education that you've shared with me is a concept of the order of money, right? And when we think about the order of money, it's like, hey, what accounts are we saving into along the way? And then later down the line is like, how does it impact us and how do we owe taxes on it? So can you explain to us, the audience, when we speak about the order of money, what do we need to understand there?
Yeah, that's a great segue. And the key that you need to understand are 7 simple words. Not all money is taxed the same, right? There's thousands and thousands of pages of IRS tax code. But if I had to condense and simplify that into 7 words, the whole thing basically just says not all money is taxed the same, right? Like Social Security income isn't going to be taxed the same as retirement plan distributions from an IRA, which isn't taxed the same as retirement distributions from a Roth IRA, which isn't taxed the same as if we sell a capital asset like a stock or an ETF or a piece of real estate. So there's all these moving parts with how money is taxed the same. And what I talk about with the order of money, and this actually came from a client of mine years ago. I was teaching them about these different moving parts of, how maybe they should have accumulated their money when they were in the accumulation phase to set themselves up for a tax efficient distribution phase. And I remember the client saying, Dave, I wish I had a time machine and I could have gone back 20 or 30 years ago to when I was 30 so that I could have understood the order of money when I was saving better, so that now while I'm here at this retirement finish line, I could have had more tax efficient distributions. And so when I talk about the order of money, Bryan, as you know, there's really 3, we call them funnels that you can accumulate your money into. There's the pre-tax funnel, which is where you're making a decision to defer taxes today to have the benefit of paying less today, but knowing you're going to pay that tax at some point in the future. And that works for some people. Like if you're in a super high income earning year and you need to create some deferrals and you absolutely know you're going to be in a lower tax bracket in a later year, it might be a good strategic move to defer today to pay some of that tax later via maybe maxing out like a pre-tax 401k, IRA, or other types of retirement savings vehicles. The exact opposite of that is what we call the tax advantaged funnel. These are things that you can put money into. You're not going to necessarily get a deferral today, but it is going to grow tax deferred, meaning you're not going to pay like interest or dividend income, or if you sell a stock, you're not going to realize a capital gain. But the big benefit is when you take it out later in life, it's going to be tax free. So if you're in a lower tax environment today and you believe taxes are going to go up in the future, either because the government raises taxes or because in the future you're going to be wealthier than you are today, that might be a good decision. You're paying the tax today at lower known rates, and essentially eliminating the government from these accounts in the future. These are like our Roth accounts, our health savings accounts, for some use cases like educational 529s, and for some use cases, different permanent life insurance vehicles. So again, there's a lot of benefits to thinking about how to allocate capital there. And then the middle funnel is what we call the post-tax funnel. So the government, because there's unique benefits of deferring money into retirement accounts or investing money in tax-advantaged retirement accounts, they limit the amount of money you can put into those things. We all know there's 401k contribution limits and IRA contribution limits. So if you have the good fortune of being able to save even more money beyond those 401k and IRA 529 health savings account contribution limits, that basically has to go into the middle funnel where you're taxed on the money when you earn it. So you don't get to defer tax. You can then go make investments in stocks, bonds, mutual funds, real estate, cryptocurrency, business interests. I don't care what it is. You can put the money into it. And hopefully that money grows in value over time. That essentially creates what's known as a capital gain in that asset. And then when you sell that investment, you're taxed on that amount that you've gained. But because you're taxed a second time on the same money, it's now a preferentially taxed item known as long-term capital gains. And so the reality of it is we have these three funnels we can put money into. And when I talk about the order of money and when we teach it and when our advisors are working with clients on navigating this, it really just depends on where the client is in their evolution and their money cycle. If they're in the accumulation phase, there's a certain order to how they should save their money. How much should go in the 401k up to match? How much should go in Roth accounts? How much should go in HSAs? How much should you backfill into the 401k up to the maximum you could put in? How much you should put in taxable investment accounts? So there's an order, right, to how to arrive at the most optimal savings solution. And then when you go to retire, there's an order to how you should take distributions from those accounts. How much should we take out of our pre-tax accounts to keep us in the low tax brackets? Today, that's really 10% and 12%. Maybe for high income retirees, it's even up into the 22 or 24%. If we're thinking about how much we should take out to not create excess tax on Social Security, how much should we take out to not create excess Medicare charges, right? This is all that concept of the order of money. It's just optimizing with purpose how much we're taking out or how much we're putting into each account so that we don't have to pay unnecessary taxes.
Thank you for listening to the Holistic Wealth and Health Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or if you want to have a holistic wealth and health financial plan, please call 456-833-7000. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. J.L. Smith Holistic Wealth Management and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through J.L. Smith Holistic Wealth Management are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including, but not limited to, age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the investment advisor public disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.